will I be able to open further activity in such markets? Will services be included? When you look at goods, fine, barriers are relatively low at the moment. When you look at services, there is an incredible set of barriers to entry between countries, which would really unleash potential for growth if it was removed in a fair and mutually beneficial way.
I mean, this administration has used tariffs as a tool for trying to get better trade deals, fairer terms for U.S. companies. How much are the trade tariffs that, I mean, Madame Lagarde gave some pretty stark numbers today about the hit to economic growth we could see, but how much are the tariffs impacting U.S. business right now?
Well, first of all, and I don't believe that people across this country really understand this, when we put tariffs on another country's trade relationship with us, we pay them.
American.
Right? They don't pay them, American.
Yeah.
Or if the French put tariffs
Well, that's because the president says that the Chinese pay them.
I'll leave you to comment on that.
He comments on it.
I want to make 2 points. First of all, I think it's important to go back because why are we so interested in trade? You know, we have 330 million people, let's say. The Chinese have 1,331,000,000 people. And we want to sell to those people. If we decide that we're going to block ourselves off and only sell domestically, we're going to become an insignificant country. The second thing, which is very important, we want to buy products. I mean, you go to the households all over this country and say, well, what products do you buy? How do you get the best for your household income? And people want to get those issues. Now, I agree with the administration that there were things that needed to be fixed. There's no question about, and we all know, and I'll be there in a couple of weeks, dealing with China is a challenge because Chinese have a challenge in dealing with modernizing of their economy. And there's no question about the protection of intellectual property is necessary, and that we have to do things to stop any joint venture that requires us to cough up all our technology. And of course, in China, they've decided what are going to be their industries, and others can't join that. Well, we just have to explain it to them, and we're explaining it. So do I think it's that the president and the administration were wrong to get strong with them? No, I think it was the right thing to do for the long term. Look, there is no argument that you can make that tariffs are going to do that job alone or over any long period of time without screwing up the economy. Yeah. All right? So we have tried to say, okay, you've used those, you got their attention, you've got a great trade negotiating team. When we get to the right place, get rid of those. When we did NAFTA, and we had to do that. By the way, you remember that when we negotiated NAFTA, there wasn't even an internet in the world, That's true. Except the ones the military owned. And now we're down that, the trade facilitation agreement and all of this technology, we needed to make some changes. And the administration has said again and again, when we get that done, then we're going to get rid of these tariffs. Well, let's hurry up. And by the way, let's hurry up and get it through the Congress. So look, trade is what people argue about when they've got difficulties in their own economy. Because if you need somebody to blame about what your administration is doing or previous administrations were doing, then you blame trade because they don't vote in your country. And you tell everybody that we're going to solve everybody's problems by being tough with those folks. Except sometimes the price of products go up and the ability to sell things around the world go down, and that doesn't really work. And we have got to get back in that Pacific Agreement for the fundamental reason that the geopolitical implications far outreach the trade implications, but will have an effect on it.
Yes, absolutely.
I'm opinionated
And,
about
and,
this.
and Tom, these things actually change over the course of time, because we're both old enough to remember the days when Japan was regarded as a major threat, somebody who copied everything and took. I remember days when they were, walking the streets of Paris, taking photos of shop windows to replicate what they were seeing in there, and they couldn't. They really did not pay much attention to intellectual property. If you look now at the intellectual property efforts around the world, the Association of Intellectual Property Lawyers, all these instances, Japan is at the top of those groups, and they're very, very keen to protect IP. This is happening actually.
How did that
China.
happen? Because we brought them in?
But because well, I think it happened because it became in their interest. Because as they put more money into research and development, filed more patents, had more brands as well, they started seeing the value of IP as an asset and in need of protection and enforcement.
You don't care about intellectual property if you don't have something you want to protect. After you get to the point where you've got valuable brands and commodities and technology, then you want to move very aggressively so that people don't take yours. And it's pretty cyclic.
So it sounds like you're both fairly optimistic that there will be a deal, and it will be, Madame Lagarde, of substance, addressing some of these key structural issues.
You want to go first on that?
I'm not in the heart of the team of negotiators, and everything that we read from hearsay, secondary, indirect feedback seems reasonably positive. But a deal is a deal when it's signed, sealed, and delivered, and when the fat lady has sung. So let's wait.
So on behalf of the fat lady,
Yeah.
we're going to try and get the music together in a big hurry.
Are you involved in these negotiations?
The Chamber has been at every one of the negotiations on NAFTA, and I would say we've been also there during every one of the negotiations with China, and we've been all over on the big challenges we have in India. We have a cadre of very, very smart people in a very large group of people running our international business and our trade business, and we're very proud of them, and we are keeping the heat where the heat belongs.
I'll go back to your comment, which actually you made 18 months ago when we were together at Harvard, and you brought up again today, fix the roof while the sun is shining. Last time we spoke, you were at the Business Roundtable. You're here at the Chamber of Commerce. Clearly, you're very engaged at the IMF with businesses. What else can Tom's members and his organization do in terms of policy steps to preserve the expansion?
When I look at the drivers for growth, I clearly see investment as lagging behind in some sectors, including in this country. That's number one. Number two, when you see the threat of climate change and a few others around, investing in those activities, in those businesses that are going to move the needle and take us to, more productive, more sustainable growth and businesses is also going to be, promoted and delivered by the private sector. I'm not one of those who believe that the public sector is going to actually implement it. It will be for the private sector to do that, and it's critically important.
Is that happening?
If you heard JJ's opening comments and pointed out that today we have half the public companies we did not very long ago. And there's been a lot of investors that don't want to go public if they can avoid it because of the extraordinary attacks and criticism of and regulatory pressure put on public companies. And I believe, and we are very aggressive on going after these attacks, I believe that what we have to do as government and the private sector and the legal community, we have to be very, very careful that we don't kill the goose that lays the golden eggs, and we've been pretty busy on it. Although I would sort of predict that you'll see a lot of movement in the right direction on that pretty soon.
What about investment? There was supposed to be this big investment boom after the administration's $1.5 trillion tax cut, which primarily lowered the corporate tax rate. What's happened to that?
You lowered the corporate tax rate, and you found the lowest unemployment in the last 65 years in this country. You found an extraordinary progress in companies investing, by the way, and also providing benefits for their investors. Because when the government and everybody says, well, they got some of that money back and they gave it to their investors. Can you imagine doing that?
Buybacks?
What do you think? Well, some buybacks, and other people had other ways to do that. And the investment in new technologies and new steps going forward. If you don't grow, if you don't change, if you don't invent, you go backwards. And, you know, we could all look at the tax deal. Remember, it's always fun to talk about taxes all the way back to the time of Christ. And well, read the Bible. And I'll tell you that we spent a good 12 years with under 2% economic growth in this country that put us in a big hole. That tax bill, whether you like it or you didn't like it, changed the mentality here, and people started to move, economic growth, more employment, a better look to the future. And now if we fix the trade deal, I think you might say then the tax deal was even better. Because it's not the tax deal that's the weight on this economy. It's the way we're in the process of fixing the trade deal. We got to get the process done with and get going, because no buying, no selling, no growth.
That was going to be my question to you, Tom, actually. Do you think that if the trade landscape is certain, settled, agreed upon, with no more trepidations and anxiety, do you think that the corporate sector, which has benefited from this tax bill earlier on, will actually move to more investment than it has so far? But because, yes, you're right, unemployment is at rock bottom, wages have begun to shift up, and there has been some added investment, but there's been a lot of share buyback programs, a lot of legitimate, compensation for investors who have trusted the enterprises. But do you think there will be more in terms of investment?
Yes, but I think we have to look just for a minute about a fundamental reality. If you pick the last, 6, 7, 8 weeks, it's my view, without a lot of proof, but, talking to Kevin and economists here and people, that all of a sudden a lot of people that have been putting money in and out of markets and investing in new technology, and they're holding on to their cash. They want to know what's going to happen to Brexit. They want to know what's going to happen in Venezuela. And remember, when you look at these issues, they're not about one country. True. You look about Venezuela, it's connected to Colombia by a bridge, and there's more than 1 million Venezuelans living there. You've got 20,000 plus of hard-nosed Cuban troops in Venezuela. You've got the Russians who have got $25 billion invested down there and are now starting to stash their planes there. And you got the Chinese with 50 plus billion invested there. And when you go all around the world and look at these complex things, they're much more complex than you think. And investors are chicken. When things are unstable that they're looking at and they're wondering what's going to happen next week, which also means what's going on in our world on trade, they say, well, I think I'll do that next week. I'll do that next month. Why don't we look at it at the next board meeting? How many times, you've been on a lot of those boards, and I have, how many times you hear in a board meeting, well, the board says to the CEO, boy, that's a great idea. Why don't we look at it at the next board meeting when we're a little more sure of the market?
There's always going to be uncertainty, though.
Well, that's, if you don't have uncertainty, remember what happened in all the big banks during that time of very low interest rates and very low growth? All where they used to make tons of money on trading, they couldn't make any money because there was no movement. And that's why they shifted a lot of their investment. Now we're back to trading. I mean, look at by the way, I don't think that the market is an articulation of the health of the economy. It's a recognition that there are people in this country and around the world that are willing to take a risk on the strength of this economy.
Do you think the market, we'll end with that comment from you, Madam Lagarde. The market is actually now a few percentage points away from a record high if you look at the US stock market. Is that a reflection of what's going on?
I think it's a reflection of the financial conditions, which have clearly eased and which are still quite favorable and supportive. We've seen it in the last few months from a malaise that was clearly also visible at the end of 2018. So I think the financial circumstances and conditions and terms that are available are clearly encouraging that. But I would agree that it does not reflect necessarily the fundamentals of the economy.
Thank you both. And I'll end with a tease and a shameless plug that you can hear more of these esteemed speakers on these topics on CNBC in the next few hours. They'll be speaking with me both. Thank you so much, Tom Donahue and Christine Lagarde.
Please welcome Insights from the Commissioners with Elad Roisman, Don Stump, and Tom Quadman.
Okay. Good morning, everybody. Good morning, Dawn and Elad. How are you?
Great. Thanks for having us.
Well, let's start off a little differently, because usually you start these fireside chats, you talk about people's bios and whatever else. But you two both have a very interesting story. You both are obviously brand new commissioners at the CFTC and SEC, but you also work together at the New York Stock Exchange. So let's go back to the New York Stock Exchange. Tell us, you're both there working sort of in the midst of the financial crisis, maybe a little later. When you were both working down, did you really think you were going to end up, being commissioners here?
No.
No. I mean, I'll start. I had just finished working on Dodd-Frank. I'd spent several years on the Hill, and it was, a challenging time, and I had the privilege of being asked to go work for an exchange and support their futures business, and I happened to work on the same team, even though Elad worked in a very different space. We worked for the counsel's office, and so we spent a lot of time together. It was great. We had a lot of fun. I wouldn't trade any of those experiences, but I always say when you leave a job, one of the hardest things is that you leave all your friends, and you move on and you have better opportunities. So I think one of the fun things that I get to do now is I get to work with a lot of people that I worked with previously, both on the Hill and at the Stock Exchange. And so it's, there's a comfort level there, I think, that you can pick up the phone and call somebody and you can have a super honest conversation about something without all the formalities. So
yeah,
it's obviously still surreal to think about that. And before we go further, I'll do our standard disclaimer that we speak for ourselves and not necessarily each of our commissions or commissioners. But yeah, it's kind of crazy to think about. And I think none of us would ever think that we'd be here today. But one of the best things about working at the exchange was, as Don said, getting to work with Don. And it was always great because if there was this tough derivative question, or if I just need to have a level set on what's actually happening in the markets, I could call Don. And afterwards, I was so much more informed about whatever I needed to do. But it was also just an incredible experience because going to work every day where you can see literally sometimes the embodiment of the American dream. You see people on the podium getting to ring the bell where they had an idea, They sat at the kitchen table, they thought about how they're going to fund it, they built it in their garage, they went to their communities, and then ultimately culmination where they get to be there and raise money through the public markets and allow investors to share in that growth. It is kind of the embodiment of the American dream. And it's the reason that our markets are the greatest in the world. It's the reason that people are able to save for college, save for retirement, and for that I'm eternally grateful. So.
Yeah. One, maybe, since you both have worked together, the CFTC and SEC recently updated an MOU in terms of cooperation and information sharing, which is really important, right? Because there is an overlap with a lot of different issues, and sometimes the agencies are coming from different vantage points with that. How do you see the cooperation going between both of the commissions?
Sure, I'll start this one. So it's been fantastic. I've seen it through various iterations, and I think we have a great relationship. I think certainly on the Title VII side, we have Commissioners Peirce and Quintenz working really well together. I think our chairmen work really well together. It's also, I think, incredibly important for us to kind of be at the table working, coordinating in the international setting, because our markets and the regulated entities we oversee are different than, let's just say, many of the other international regulators, which tend to have a bank-centric view. I mean, here, 80% of funding happens through our capital markets, and Europe, it's 80% through bank lending. And so our perspective is incredibly important given, we have a different view and a different touch point with our regulated entities, and I think it could sometimes get lost in that kind of bank-centric view. So there are many things that we work well to kind of ensure that our paradigm, our regulatory structure, is acknowledged and is respected in the international setting. But there's plenty of great work that's being done between the agencies and the staff, and I personally look forward to working on something with Dawn, hopefully in the future. So.
I feel the same way, and I honestly, even when we both also worked on Capitol Hill, and I think there were times, at least years ago when I worked on the Hill, that the two agencies, there was a bit of overlap, but not nearly as much as we have now. And so after Title VII was enacted, I think it became much more critical that the two agencies find a way forward that is consistent. It's very unfair, I think, for the regulated market participants to have to subscribe to two different sets of regulations in the United States and abroad. I mean, these are things we talk about all the time with our international colleagues. How do we get to the same place? We all agree to the same principles. In Pittsburgh in 2009, how do we make it such that it is workable for the market participants without losing sight of the objective? It's critical that we in the United States do the same, and it's the SEC and the CFTC, and I think that we're uniquely situated right now. Not only the updating of the MOU, but so many of us have worked together. Commissioner Peirce and I worked together during Dodd-Frank. Commissioner Roisman and I worked together at the Stock Exchange. The two chairmen have a great relationship. Even on our own commissions, I think there's some interesting relationships that will lend to an easier path to coordination. And I do commend Commissioner Peirce and Commissioner Quintenz for the work they're doing on harmonizing the Title VII rules. One particular issue, and anyone who knew me during the crisis might remember that I always said we've got to get the information and the data right before we move to the other elements of the reform. I clearly lost that battle, but I still think that the data coming to regulators in a consistent form is critically important, and whether we're talking about swap data or any other data set that we're going to need to be able to digest in the midst of, God forbid, another crisis or an uncomfortable time or a time of market turmoil, I think it's critically important that when we put together the swap data reporting requirements that we ensured that the data standards and the data fields are consistent, because if we did have a problem and we needed to call the SEC or the SEC needed to call us and we weren't looking at the same fields of data and it simply wasn't translating, what was the point? So, I mean,
Right.
These are things, this is just, I think, one of the most raw examples of something that we have to have consistency. And again, I know people are working on it. It's just a personal theory that I have and something I'm very passionate about. We need to get the data in the same format. So.
No, I mean, that is critical, and we can go off in a whole conversation on that. And matter of fact, if Dino Falicetti gets confirmed, he's going to be on the hot seat up here. We're going to talk about that because that was one of the reasons why we created OFR. But you know, Dawn, you recently, 2 weeks ago, you gave a speech in Europe, and you know, actually, we were in Europe at the same time doing advocacy with a lot of different regulators. But can you talk a little bit about what you talked about? Because there is a lot going on in the international regulatory sphere in the financial services. Yeah. And you know, so maybe if you could talk a little bit about that.
Sure. So I've said many times since I've been at the Commission that I think we oftentimes forget that there were a set of 4 principles that the G20 agreed to in 2009. They were increased clearing for over-the-counter derivatives, increased platform or exchange trading, uncleared margin for things that are not centrally cleared, and reporting. There's another element of the G20 reforms. Even in 2009, the folks who were sitting at the table recognized that we might not get it exactly right the first time, so they wrote this clause into that directive, and it says that we should assess regularly if we're meeting the goals of addressing systemic risk, ensuring that there's more transparency, and mitigating inappropriate activity, I believe is the words that are used. But that's great. The CFTC happened to have gone first in applying their regulations, not only in the United States, but into other jurisdictions. Now that everyone else has subscribed to a set of principles, or not everyone, but most everyone, in large jurisdictions, Europe in particular, I think it's time for us to step back and say, if we truly have comparable regulations, is it a benefit to the system to have every regulator, the CFTC included, regulating every institution around the world, or should we really trust each other that we put in place comparable regulations and we're working to ensure that they're harmonized? The speech in Europe touched on all 4 of these elements, but I'll just talk about one of them that I feel very strongly about, which is whether or not you believe that CCPs were the solution to the crisis, that is where we are, that there will be more centrally cleared over-the-counter derivatives. The reality is that I have a very serious concern that the CFTC has imposed our authority on CCPs and other jurisdictions, which I think ultimately will result in retaliation, such that every other jurisdiction wants to impose their authority on our clearinghouses. This may seem like a great idea. My concern is that if we had a crisis, or we had a problem, not even a crisis, a problem where a clearing member goes down and we need to resolve that particular issue, and multiple regulators are standing at the door of the clearinghouse saying, we all have comparable regulations, but they're not identical, and what my regulations require is what you should address first. Have we really served the clearinghouse well by doing that? I mean, the reality is comparable regulation were the objective. Identical regulations are never going to be the way this works. And we have to trust each other to, one, we have to have data that allows us to communicate. And